Joining me for a look at how the local markets have fared is Andrew Dittberner, Senior Investment Manager at Cannon Asset Management. Andrew, listening to David Constable there, a couple of the things that came out of that was, one was doubling production in 10 years, another was gearing going up to 40, whereas at the moment it's 6-7%. Sounds quite a risky long play, this.
Yeah, I think if you take a step back and look at the results coming out today, first of all, before we get onto the growth plans, I think these numbers weren't as bad as they looked. Headline earnings per share is up 2%. The impairments in Iran hurt that, and translation losses on exchange rates also hurt. So if you remove that, I think that was a cost of about 3.6 billion.
Yeah, because if you look at numbers where you've got profit up by 9% and production up 10%, earnings just by 2%, you need an explanation like you've just given.
Exactly. So if you look at the operating profit, it was up 9%, and I think that's a reasonable performance for this business. So all in all, I don't think it was a bad result. They've got a strong balance sheet, as we've just heard, and it's cash generative, so it can support this dividend policy. They're a very nice dividend payer on a 4% dividend yield. Obviously, the big risk is their growth, their capex over the next 5 to 10 years, in the US in particular. I think these gas assets have the ability to transform the global energy environment if they get it right.
When you say risk, what kind of risk are we talking here? You say their balance sheet is strong at the moment. There are kinds of risks that Eskom is having with capacity to build, the risk of getting it done in time. There are financial risks. What are the risks?
Exactly. I mean, there's a myriad of risks here. You know, the obvious risk is if they run over budget. These are huge projects that they're taking on, and if they get it slightly wrong, it's very technical projects. If they get anything wrong here, it could end up costing a lot of money. The cash flow, which supports this dividend, which I just spoke about, that will disappear. Dividends will disappear.
Although this is what they do, isn't it? I mean, it's in their DNA to do big, difficult things.
Look, when you look at their gas to liquid in Qatar, I mean, this is probably the world's best gas to liquid plant up there, and they've done it very well. So, you know, then you can look at other projects that they've taken on. Iran's the obvious case in point. You know, they've had some success in certain places, and other places not so much. So there's definitely, I mean, that's a huge risk. But if you look from a valuation point of view, I think Sasol looks attractively priced at the moment. Historically, they trade between 50 and 60% of the Rand oil price, which today would suggest it should trade in excess of 500 Rand. Right now, it's at 400 Rand. So we think there's some definite value there. However, this is a long-term play. If you look at their earnings, it's almost perfectly correlated to the South African oil price. So in the short term, you know, obviously with what's going on in the developed world, the highly indebted Europe and the US, you know, oil could come back. But I think a longer term, if you have a longer term view rather, I think, you know, there's good reason to own Sasol.
Just watching David Constable there, it struck me he's settled into the company now, succeeding Pat Davies, who was there for quite a few years. The market likes him? Yeah,
relatively unknown, I think, when he started, but he seems to have settled in very well. Yeah, and definitely no concerns from us. We are shareholders, and I think the market as a whole tend to like him.
Let's look at two other fairly large companies that have reported today. One is Sasfin Holdings. We saw Roland Sassoon there a little bit earlier. Nice results. Profit up 20%, headline earnings up 22%, dividends up 22%. Now, there are quite a few companies that have had strong dividends recently. With Sasfin, he made a point in that interview earlier. He said, if a big bank loses 1% market share, that can mean a 10% increase for us because we're smaller.
Yes, exactly. I think that's the beauty of being a small business in this environment. Their results showed it. Headline earnings, they have come off a fairly low base. They've had a tough couple of years. Recently, headline earnings per share up in excess of 20%. What was really nice is that they grew the top line. So from that top line, it went down to the bottom line. It wasn't a case of reducing costs, which they now need to focus on. I think if you look at their cost to income ratio, it's in excess of 70%, and they've been saying for some time they need to get that down to below 65. So they need to look at their costs now. They're growing the top line nicely. Non-interest income, or revenue rather, also came in very nicely. So I think they're doing a great job. Yeah, they just need to watch their costs.
He's also talking about growth in East Africa. Alicia couldn't get out of him exactly where. They obviously haven't said anything yet, but that's a prospect there for growth beyond South Africa.
Yeah, it's the first I've heard of it. I didn't see it mentioned in the results today, just listening to the interview before. You know, obviously the obvious place for South African companies to grow is into Africa. Again, this comes with huge risk. We've seen companies in the past, banks in particular, I don't need to name them, that have gone into Africa and have got their fingers burnt. So it's, again, the obvious place to go, but you need to tread carefully.
Well, possibly Sasfin can learn from whatever mistakes they made, and other companies have done very well. One thinks of SAB Miller and Shoprite, for example.
Exactly.
Let's look at AVI with Angloval Industries. Food and consumer goods, revenue up 11%, headline earnings up 8%. Again, another question there. If the revenue's up by that, earnings by slightly less. Profit also up by slightly less.
Yeah, I think overall quite a nice set of results. The obvious problem there is R&J. R&J had an exceptionally difficult year. There's a lot of exogenous factors that it's exposed to. They had problems with their fleets, fuel costs went up. So yeah, we saw, I think their margins halved, R&J. So that was the problem child for them. If you strip out R&J, their trading profit came in at about 16%, so the rest of their business is doing really well.
How much are they exposed to defensive stuff like purely food, which people have to buy, and things like shoes, which perhaps you can defer a while?
I think their food business at the moment makes up about 60% of earnings, if I'm not mistaken, and their fashion business, the remaining 40%. Their food business is not, I wouldn't describe it as being as defensive as some of its competitors like Tiger Brands and Pioneer that deal in bread and that sort of thing. AVI, I've got, I mean, it's snacks, biscuits, that sort of thing, tea. So it's not as defensive as some of the other food producers, but it's a very nice mix. You got food and you got clothing. So quite a nice mix. They're not too exposed to the rand. R&J is an exporter. They need imports for their food. So they've got a bit of both there. So rand weakness helps R&J. Rand strength helps their food business. So they're not too exposed there. It's a very nice. They've got a strong brand. And their food, I mean, their fashion business has very nice earnings momentum behind it. So I think all in all,
it's a balanced company in many ways.
Yeah, it's just looking, I think at the moment on a PE of 17 is probably a little bit expensive.
A little bit high, yeah. Just a quick comment on the market as a whole, up 0.5% today. And I was just looking at 3 months ago, it was at 38,500. 6 months ago, it was at below 36,000, and it's now touching 41,000.
Yeah,
it's going to go on.
It's been a very strong run, I think, over the last 6 months, in particular. If you look towards the end of July, we've just, I suppose, we're coming towards the end of our earnings season at the moment. All the companies that had results or year ends in December, and there's been a mixed bag. I think we're not going to see this market re-rating at the moment. The market as a whole is on a P of about 17 times, which is quite pricey.
Again, quite high.
If you look through the cycle, it's slightly more attractive, but this is definitely a stock picker's market at the moment.